Hey, hi everyone. Thanks Ethan for the wonderful introduction. Let me just share my slides with you. I do see some familiar names who regularly tune in for the weekly market scoop. So I think some of the content for today's presentation was actually, it was presented earlier in the weekly market scoop series. My views, in a way, hasn't changed. Of course, now we know that the markets have been sort of unprecedented, right? I mean, we have this very strong rally in the first half of the year. And then just over the past 2 months, we are seeing that markets are getting accustomed that rates will stay high for longer. And that is really calling for some form of a de-risking. In a way, I believe that what markets are pricing now is that, when longer term rates are rising, you have seen all the headlines on the US Treasury yields just keep rising every single day. That has really been pressuring equities, right? I mean, if your risk-free is so high, I think your equity got to deliver much more in terms of a return. So with that, there's also some pricing that with longer term yield, rising, something will eventually break in the economy. So later on, I will share some of the sort of my own view of recession indicators. I think I have shared earlier in my market scoop series, and we are starting to see some materializing in terms of the steepening of the yield curve. But I think there are several other signals that we can put on the radar, but hasn't really played out yet, but definitely something that we can observe. So without further ado, let's just move straight into the presentation. And before that, some disclaimer. Of course, this webinar is just pure sharing. It's just sharing my views. There's no right or wrong. It doesn't constitute any investment advice. It's just sharing, where I'm looking at the market from my point of view. And of course, it's for educational purposes only. Okay, I think Ethan has done a wonderful introduction of me. So I won't delve too deep into my background. Just 2 things that I just want to share with the newcomers for this webinar. One will be my Twitter. So if you're on Twitter, you can give me a follow. My Twitter handle is @it_IG. If you are more prone towards Telegram, which I'm sure is more popular, at least in Singapore, in the Singapore base, you can follow this Telegram called IG Asia. So I think every day there will be daily updates on certain events and also some trading ideas which you can follow, and it's totally free. So the Telegram name is IG Asia. Okay, let's move straight into the markets. So I think now, you keep seeing these headlines everywhere that markets are getting accustomed to this narrative that rates will stay high for longer. Definitely when we have that, we have that hawkish takeaway from the Fed. They are still looking for 1 more rate hike by the end of this year. And they are only pricing for 2 rate cuts in 2024 as compared to in June, where the Fed say they were looking for 4 rate cuts. So it is a toning down in terms of a rate cut. But generally, my view is that when the Fed is looking for lesser rate hikes, it means that economic conditions are much more resilient. Yes, it can be. I believe that it can be somewhat a positive if you think of it from another angle. I mean, yes, rates can stay high for longer. But it just means that economic conditions are still holding up, and corporate earnings could potentially hold up. I mean, generally when markets see a downturn is when during periods of a rate cut, because when we see more aggressive rate cuts, in a way it does suggest that economic conditions are moderating very, very sharply, such that the Fed has to react accordingly. So in a way, markets are still in this short-term phase of trying to get accustomed that, when rates stay high for longer, there is this chance that something will break and there will be sort of a recessionary kind of a scenario that play out in terms of the markets itself. So fine, I mean, let's just see how markets will turn out once markets get accustomed to this general narrative that rates can stay high for longer. I believe the greater focus will be shifting towards what the Fed will do next. Because what the Fed say and what the Fed do, I believe is two different things. Okay, of course they have to stay hawkish. I mean, their tone, they cannot lax on their tone, because inflation is still several times more than its inflation target, so they got to maintain a hawkishness. But what they do next will definitely be key. Okay, whether they will follow through with that last rate hike through the rest of the year, I think that will be something that we will watch in November and December. Okay, but just for now, a broad overview here. Year to date, Nasdaq still outperforming as usual, followed by S&P 500, and then the Dow Jones and the Russell 2000. So in a way, even with that retracement, I think the Nasdaq is still more than 25% up year to date. The dangerous one will of course be the Dow Jones and the Russell 2000, largely because when you have a greater exposure to sort of value companies, much of it is, in terms of the Dow, it's more of a dividend paying kind of a status. And when you have this high for longer kind of a rate, you really challenge the traction for holding some of these value companies. And of course, for the Russell will come in terms of the economic risk. They are more prone to debt borrowing. So when you have high for longer rate, you really create that pressure of economic risk for these smaller companies. So that's the whole narrative that is sort of playing out, at least in terms of the US indices. And if you look at the Asian indices, the outperformer is still the Kospi and Nikkei, which is more prone to, which is more exposed to the growth component. Whereas the other kind of indices, like the STI Singapore Index, the STI, the ASX, CSI, those are under pressure. I think in terms of Asian indices, things are a little bit tougher. I think the backdrop can be a little bit tougher. Why? Because generally there are a lot of headwinds that Asia is facing. I think one is, of course, that global bond yields are increasing. Next will be in terms of the stronger US dollar. So generally, when a US dollar is stronger, the Asian region tends to come under pressure, largely because of that debt exposure in US denominated. So that is the second headwind. The third one is, of course, China. I think the region is also very sensitive to the economic health for China itself. I mean, the region is very much export driven. So when China demand is not improving as sharply as what is expected, that really creates some form of a spillover risk for the growth in the region. And moving on, we also have higher oil prices. I think a lot of economies in the Asian region are oil importers, such as Japan. So when oil prices are moving higher, that really questions on that higher cost for many of the corporate firms in the Asian region. And last but not least, seasonality. I think you have heard it throughout, over the past 1 to 2 months on that weak seasonal pattern during this period of time. So you can see that there is really a list of sort of headwinds that Asian indices got to deal with. And economic conditions have shown that it hasn't been as resilient as things in the US. So the US is still the more resilient one in terms of economic conditions, whereas Asian indices are kind of on this flat growth stage. The only exception is in terms of India. India is sort of pulling ahead in terms of growth, but largely the broader region is still sort of under pressure in terms of economic health. Okay, some other broader chart itself, just to show that growth is still the outperformer, at least on this year-to-date front. In terms of FX performance, it is all about that US dollar strength. So we are seeing that things are overall kind of flat, but over the past 2 months, the US dollar has grown much stronger on this hawkish recalibration in the rate expectation. So that is really weighing on many of the major FX pair. Of course, one that stands out will be the Japanese yen. So Japanese yen has been one of the weaker currency year to date, and we know it's due to that policy divergence between the US and the Bank of Japan. So how long it will last? We got to wait and see. But generally, I think market expectations are that the Bank of Japan may be forced to make a move during the first quarter of next year. So that is being priced in terms of the interest rate futures at the moment. And I think the Japanese authorities have also laid the groundwork. They believe that there is some data by the end of this year in terms of wage growth to determine how they will move forward in terms of their policy pivot. So we could be inching nearer and nearer to that, to that moment of reckoning for the Japanese yen. So that will be something that we will watch at least throughout this year itself. Okay, so I think previously I shared this. Previously, market is in this narrative that we will have a soft landing. I believe that we are still in this narrative. It's just that the Fed has stand out and say that with more resilient economic conditions, they may be forced. Okay, they may be forced to keep rates higher. They may be forced to keep rates high for longer. And this is what is really happening. On the left side, we have the inflation chart. So inflation has kind of been moderating quite well. It's just recently there was this slight uptick on higher energy prices. But if you look at the core, it continues to moderate, and the core is generally what the Fed has its focus on. So I think inflation is still on this, allowing the Fed to pull off some wait and see. And in terms of economic conditions, if you look at the chart on the right, the US has been much more resilient than the rest of the world. So this is the economic surprise index. Generally, when the reading is above 0, what it means is that the economic data is outperforming market expectations. Okay, of course, when it's below 0, it means that the actual economic data is underperforming underperforming what market expects. Okay, so the higher it is, it means that there is a much more positive surprise on the economic data front, and US has really been sort of pulling ahead with that as compared to the rest of the world. And we have just seen, some resilient jobs data that has come out, yesterday, the job openings data with the lead up to the US non-farm payroll this Friday. So in a way, some expectations are that the labor market may remain resilient. And what this means is that, the Fed may continue to leave rates high for longer. So that's the whole narrative that has been driving this de-risking in terms of where that we have this soft landing hope, but the Fed may be forced to take on a more hawkish stance. But of course, like I said just now, I think what the Fed says and in a way what the Fed do sort of can be two different things. I mean, recently they have keep rates on hold. Of course, they leave the flexibility of having one more additional rate hike by the end of this year. But whether they will follow through with that, I think markets generally have their doubts. And if it really turns out that they are shifting towards a rate hold in November, the narrative that we could have seen, the peak in the Fed's hiking cycle, that could generally be well received by markets. Of course, they are being very data dependent. With that, we are also being very data dependent. It will really depends on the jobs data and of course the upcoming inflation data before the November meeting itself. Okay, so slightly shifting away from the economic side, this is how the large speculators are positioned in terms of the S&P 500. So this is the CFTC data, sort of the futures positioning, but it sort of gives some idea of where the large speculators are sort of positioned. And when you think of it, you can think of them as, potentially hedge funds. You can see that during the first half of this year, they have been missing out on the rally itself. You can see that they were holding extreme net short position despite the US indices rallying. So they kind of missed out on the rally for the first half of this year, and on recent months, they are really trying to catch up to that rally. So we can see some unwinding in terms of their net short positioning. So now the position is, at its lowest level. Their net short positioning is at its lowest level since April. Okay, so whether we can see further unwinding in that sense, definitely we can keep a lookout. But generally, what I want to show with this is that there is some room for further unwinding in the net short, and which could potentially translate to some buying pressure for the US indices. Okay, next chart that I want to show you is this high yield corporate bonds versus the US Treasury bond. So when I look at this, when I look at this chart, what it tells me is the market expectations for economic risk. So generally, when this ratio were to be on the decline, okay, generally it means that the credit spread between the high yield and the treasury are widening, which means that there are more economic risks being priced. And that is what we have seen sort of happening over the past few weeks. You can see that this ratio, has sort of fall quite sharply, especially after when the Fed guided for this high for longer rate. So how I make of this is that when markets look at that Fed guidance that the higher rates could stay for longer, it does carry a greater trade-off for economic conditions. So in a way, they are pricing for some economic risk. They are pricing that when rates go higher, something may potentially break in the economy, and that is what has been driving this this sharp decline in this ratio itself. So if you are a believer that you can use TA on ratio, this has actually been back to its previous low. Whether it will form a new low, I think that will be definitely something to keep a lookout on, or whether it could sort of rebound from this case. That will be something to watch as well. But generally, we are at this point of reckoning where markets are sort of in this indecision phase, where we have rates going higher for longer, whether the economic conditions can weather this. That is something that has really been driving that full-on de-risking that we have seen over the past few weeks itself. Another thing that we are watching is the VIX index. If you are familiar with VIX, generally it has an inverse relationship with the S&P 500. And now it is actually back to that key 20 level. So generally when we talk about S&P 500 VIX, there is this sort of a well-observed level of 20. Generally, when things are below 20, buyers seem to find a conviction for a more risk-on environment. Because when we talk about VIX index, it's largely that fear gauge, right? So when things are low, it means that there's lesser fear in the markets. We are more in a risk-on kind of environment. And when we are above 20, it means that things could be a little bit more shaky. We could expect further volatility ahead. And when we talk about further volatility, it means that a potential downside risk for major US indices. So you can see that 20 level has been sort of that well-observed mark. We have moved to retest it back in May, didn't manage to reclaim it. We have moved to retest it back in June, didn't manage to reclaim it as well. So now we are back at this level. Okay, so now we are back at this level. If things were to sustain above this 20 level, so I think it does suggest that sellers are really in greater control, and that could create further downside, okay, for the US indices. So this 20 level will be something that we will be watching very closely. Okay. On the other hand, if things were to sort of revert back below 20, we could still continue to trade on this more risk-on environment. at least over the next quarter itself. So something to keep a lookout for. Now we are really at this point of reckoning in terms of the big index and in terms of that high yield bond to a treasury bond ratio. Okay, so this is the global manufacturing PMI heat map. So like I mentioned, I think what markets are worried about could be in terms of the economic risk that comes with that, high for longer kind of rate narrative. They are not wrong. If you look at over the past few months, things have been moderating. It's just that, things have turned in softer, but we haven't seen that huge global recessionary forces playing out yet. Okay, so if you look at the manufacturing PMI heat map, things are still on the softer side. Okay, somewhat resilient picture coming out from, like you can see from India itself, Canada recently, August surprised to the upside. Some other data has also been turning higher, turning higher from August to September, but things are still generally weak on that front. So it's really, whether economic conditions can continue to hold up. And I believe this recession narrative will continue to be top of the town into the rest of this year or into next year itself. So that will be something that we will keep a lookout for. But generally, things are on this softer side of things. It's whether things are holding up. Okay, and I just want to share this chart with you. Okay, so this is the chart from the 1970s, where the story in the 1970s is where we had this resurgence in inflationary pressure, and that is what people are worried about, right? When people are worried that inflationary may rise for the second wave, and then the Fed may be forced to really hike rates further. But I was looking at this chart from the 1970s, where we have that second wave of inflation, and at that time, the Fed has actually prematurely cut rates, and then thereafter they are sort of forced to sort of increase rates quite aggressively again. Okay, and if you were to track it with the S&P 500. Generally, what you observe is that during the second wave of resurgence, when there was this resurgence in inflationary pressure, when the Fed is hiking rates, back in the 1978 to 1980, the S&P 500 kind of find some upside. Okay, so it is really kind of a puzzling, right? I mean, when the Fed has been aggressively increasing rates, generally you will expect that equities will come under pressure. Not wrong the first time round during the 1973 to 1974, but on the second wave itself, you can see that the S&P 500 seems to hold up well. And the reason for this, I believe, this is my view, the reason for this is that, there is some expectations in place that, economic conditions can sort of weather that kind of rate hike. Okay, and the only form a top in 1981 where we have a recession. Okay, so you can see that the S&P 500 generally increased during the second wave of inflation until recession hit, and then there was sort of a downturn from 1981 down to 1982. So whether the same thing can play out this time around, of course, it's up to anyone's guess. But just for me, I believe that what this shows, okay, of course, it's just one data point, but we only have this incident to, sort of track against the current situation. So what my thinking for this is that, when eventually markets believe that economic conditions can hold up with rates going higher, things can continue to move on the upside until they are convinced that recession will start to seep into the economy, and that is where the markets will form a top. So I believe now what markets are really pricing in is that huge potential economic risk, whether it has played out yet, potentially, but there isn't much of a clear signal at the moment. Okay, so of course we have to look towards the upcoming data, but really just to show that I believe that if markets believe that economic conditions can continue to hold up, there is some sort of a potential for upside in terms of the US equities. Okay, so with all that talk about recession, okay, whether we will have a recession or not, of course no one knows, right? Usually a recession tends to come unexpected. Okay, when you most expect it to come, it doesn't come, such as at the start of this year. And when generally the narrative is that when nobody expects a recession, that is where it comes as a surprise. So most of the recession generally comes as a surprise. Whether we'll see it or not, of course, what the best we can do is to really look towards some of potential indicators, which personally I will share with you what I'm looking at. So the first up, in terms of recession, one thing, of course, you have seen in the headlines is the US 10-year to 2-year Treasury spread. So generally, when people say when the yield curve inverts, it is a predictor of recession, and it has held true during a past recession itself. Okay, when things invert, generally a few months later, a recession tends to follow. Okay, but it doesn't really tell you that timeline. It doesn't tell you that timeline of when things will actually happen. But at least based on past few recession, when things uninvert, meaning when that spread moves towards a positive territory, generally a few months later, a recession tends to follow. Okay, you can see it in the 1990s. Okay, you can see it in the 2001, 2007, even recently that COVID-19 in the 2020, when things uninvert, okay, when the yield curve uninverts, generally a few months later, a recession tends to follow. So whether it will play out this time round, nobody knows, but it will definitely be something that we will keep very closely on the radar, especially with that very strong bear steepening that we have seen over the past few months. You can see that things are moving towards an uninversion at the moment. So the moment where things fully uninvert, I believe that will be something that we will have to be more cautious. Okay, so this is one of the indicator that I have. And the puzzling thing is that now we are talking about a bear steepening. And generally, historical suggests that during a bear steepening kind in the yield curve, the equity performance should be positive. Okay, but now the narrative has been different. Okay, in that markets are believing that what this suggests is that the Fed has to be more hawkish. That will come as a trade-off for economic risk. Okay, fine, but generally it's kind of a mismatch with the performance that we have seen during previous bear steepening itself. So we got to keep more vigilant in that case. But generally, I believe what markets are pricing is really that growth risk. So we really got to see some pushback on that front over the coming months to suggest that the Fed will ultimately head towards a rate pause, and economic conditions can sort of soften but still continue to hold up and push back against some of that recession fears that we are having. Okay, so something to watch right there, the spread between the US 10-year and 2-year Treasury. Okay, the second indicator that I have, okay, this is the Atlanta Fed real-time GDP estimates. So this is from the, you can actually Google this, it's readily available. This is a more real-time estimates of where GDP is. And this is the current third quarter estimates from the Atlanta Fed itself. So you can see that economic conditions are quite strong in that the third quarter estimate from the Atlanta Fed is actually priced at around 4.9% growth. So it doesn't point towards any near-term recession playing out. Okay, 4.9% is still a very strong growth based on their real-time estimates. Of course, how things will change, we got to keep a lookout, but at least for now, it suggests that recession is still not here, at least in the third quarter, based on this data itself. So I think moving forward, if the Fed is able to, when markets are convinced that the Fed will ultimately head towards the peak of its hiking cycle, moving on towards more wait and see over the coming months, and economic conditions continue to hold up, that could be, something that the bulls could tap on to sort of fight back against this recent retracement itself. So second indicator, that Atlanta Fed growth forecast. The third one is the US consumer sentiment. Okay, we know that the US economy is very exposed to US consumer spending. I mean, US consumer spending takes up roughly 2/3 of the US economy. So generally, in past recessions, we see a sharp dip in consumer sentiment. Okay, so consumer sentiments weaken very sharply, and thereafter a recession follows. For now, if you were to ask me, we are still seeing consumer sentiment sort of holding up. So our consumer sentiment is still strong, and especially heading into the fourth quarter, that is the holiday season, right? So it will really depend on how much the consumer spending can hold up. But at least for now, there isn't much of a recessionary signal that is playing out yet. Okay, we can see that consumer sentiment has sort of rebounded, in the from its previous low around 50 mark, and it has still been sort of staying resilient at the moment. So US consumer are sort of holding up. So there isn't much of a recessionary kind of forces that is revealing from this data itself. So it does suggest that near-term, growth may potentially hold up. And one to watch will, of course, be the upcoming earnings season, right? I believe that once markets get accustomed, once they get accustomed to this narrative that rates will stay high for longer, fine. What will come next will still be that US corporate earnings moving forward on whether that will dictate that direction of the major US indices, and we will have a clue of that. We are heading into mid-October. We will have a clue on that, on how corporate earnings can hold up. And at least based on the current data, it suggests that there is some chance, there is the odds that corporate earnings could continue to hold up in the third quarter itself, based on that very strong GDP reading, based on consumer sentiment still sort of being resilient. So there's these odds that earnings could sort of outperform market expectations, and I believe that will be what markets will shift its focus on, at least towards the second half of October until the rest of this year. Okay, the next recession indicator, one that has already flashed a recessionary signal, will be the leading indicator from the conference board. So you can see that you can also easily Google this data. So generally, the leading indicator does suggest the 6-month kind of a growth rate. Okay, so it has already dipped below a recessionary signal, but so you can see that there's kind of a mixed picture. But based on that consumer sentiments and based on that uninversion, it hasn't really played out yet. So whether it provides some room for US equities to sort of push, sort of challenge the bears in this fourth quarter, that still remains a possibility for sure. Okay, next, when we talk about recession, of course, we cannot spare the US labor market. That has been that very strong showing, right? And recently, jobs opening has continued to outperform. It just means that US labor market are still resilient. And if you look at the continued jobless claims data, so when we look at jobless claims, there is the initial portion and there's the continued portion, right? So the initial portion is where the members are unemployed for the first week, and the continued tends to show a more prolonged form of unemployment. Okay, so when we look at this more prolonged form of unemployment in terms of the continued claims, generally during past recession, you can see that the level of reading is roughly around that 2.4 million to roughly 2.6, 2.8 million kind of a mark. So that tends to signal the start of a recession. So what we are looking out for is whether we will see any sort of a sharp upward reversion over the coming months. Currently, we are around 1.6 million. So it's still some room away from a recessionary territory. Of course, if you look at the data in 2020, I believe that is sort of an anomaly. I mean, we are seeing 1.8 million form of continued jobless claims that marks the onset of recession. But I mean, the COVID is kind of an unprecedented event. It comes quickly, it comes suddenly as compared to the past few recessions. So I think that could be an anomaly. So what I'm looking at is that 2.4 to 2.6 million kind of a mark. Currently, continued jobless claims has been sort of moderating, has been trending lower. So I think this also sort of continued to push back against that economic risk that we are not seeing, at least in the near term itself. Okay, next up, I think unemployment rate. Okay, unemployment rate, generally, we got to see that huge sharp uptick in the unemployment rate to mark the onset of a recession. The talk of the town is that with unemployment rate hovering around this 3.6, 3.8% level, the only way is up. Okay, fair enough, fair enough. The thing is whether, you know, once we reach that 4% kind of a maximum unemployment that is the Fed's target, you know, how much upside surprise that it can actually give us. So that hasn't really played out yet. Of course, we got to look data by data, kind of a data dependent stance ongoing here. We will have the fresh updates on the US unemployment rate this Friday. Of course, we will see whether things can continue to stay resilient. Okay, so I think things are still kind of shaky in the near term. I mean, when markets are still on this high for longer kind of narrative, because that is the catalyst that has been playing out, right? The US earnings season are still a few weeks away, so that is still the ongoing narrative, along with seasonal factors. I think first half of October could still sort of be shaky, but really what matters is when the focus shifts towards the earnings season, whether the bulls can find the catalyst to fight back into the fourth quarter. I believe there's a chance for that. But for now, I think the sellers are still in near-term control. So we got to see how things play out from mid-October onwards. Okay, so sellers in control for now. You can see that there are some catalysts that, you know, the bulls can tap on to sort of fight back in the fourth quarter. I mean, the earnings season is one. The Fed rate expectation is another one. So if you were to recall the recent Fed meeting, the Fed said that they've got to push on further with further hikes. Okay, they continue to maintain this hawkish stance, but they actually kept rates on hold back in September. So of course, the question is, if you are expecting rates to move higher, so why do you still keep rates on hold when you can, you know, push on with further hikes? So I think generally, the data dependence then is still very much present. Okay, they keep rates on hold, but they leave the flexibility that they may have to hike further in light of, you know, depending on how economic data plays out. And markets are not believing them that they will follow through with their large rate hike. So this is the most updated rate expectation, okay, that I pulled out this week. So you can see that markets are still pricing that the Fed will, that we have already seen, okay, the peak of the Fed's hiking cycle. Okay, so you can see that in November, a continued rate pause has been priced for the Fed. So if the Fed, you know, follow through with a rate pause in that sense, I believe that could fit into the expectations that we could already see that hike. That could be something that the bulls can potentially tap on at least through the rest of this year until things show otherwise. So that could be something that could be, that could be a catalyst for the fourth quarter that we can keep a lookout for as well. Okay, if you look at the sentiments, I think some of my favorite sentiment indicators, okay, that we can keep a lookout for. Number one is the market breadth. So we have the S&P 500 stocks above 50-day moving average, has clearly moderated from the July peak. Now it's moving towards near oversold levels. So of course, what I'll be looking out for, you can see that when things, at least in the near term, when things tends to reach extreme oversold levels, at the July bottom and the October bottom, which kind of coincide with the April 2020 level, that could be something that could drive some form of a short-term rebound that could provide some opportunity, okay, for us to sort of ride on this near-term reversion. Okay, that will be something that I'll be keeping a lookout for. Now we are edging lower, and once it reaches that line that I've drawn at the bottom, we can keep a lookout for any form of a bullish setup. But now things are nearing that sort of oversold levels. If you look at the CNN Fear and Greed Index, okay, it kind of measures where the broad risk sentiments are. We are heading into extreme fear territory. And of course, generally over the past few instances, when we head towards that extreme fear territory, generally there is that short-term rebound in the equity markets. So now we are nearing that form of extreme fear, whether that recent sell-off is sort of an overreaction. Generally it does, there's an odds that it could be an overreaction, right? But what we are looking out for is that when things are in extreme fear, you wouldn't, in a way, at least on my point of view, I wouldn't want to go short any further. I could, sort of find a long opportunities for that short-term rebound moving forward. Okay, more market breadth indicator. This is the stocks above the 100-day moving average, and this is stocks above the 200-day moving average on the right. So likewise, now we are back towards a more oversold levels. Of course, something that we can keep a lookout for will be whether things can hold up. So you can see that the 200-day moving average is actually back to its April to June kind of low, and that marks somewhat of a rebound in the US equity markets. So now we are back at this level. Whether market breadth can revert higher, that will definitely be something that we will keep a lookout for. That could drive some form of a near-term relief, at least in the near term, that we can definitely keep a lookout for. So at least now it does, for me, suggest that the buyers of going short seems to be riskier, at least from this risk-reward kind of perception. Okay, and other sentiment indicators, bull-bear spread, not too much signal here. Generally, what we are looking out for is the extreme top and extreme bottom. Now it's just barely below zero. Doesn't provide much of an extreme form of a swing in terms of their readings. The VIX could be sort of more interesting. Generally, the VIX tends to move sharply higher between that September to early October kind of a period. But thereafter, from mid-October towards the end of this year, the VIX tends to moderate. And we know that the VIX and the US equity indices have this inverse relationship. So when VIX are sort of softening, sort of moderating, generally it suggests that the seasonal patterns for major US indices into the fourth quarter can be on the upside. Okay, that is just based on that seasonal pattern that we are seeing. So definitely that's why I believe that mid-October, that earnings season will be key. Once market have its focus on that earnings season, whether it will continue to deliver, that will really drive the market trend over the coming months itself. And at least for now, it does suggest that economic conditions are still sort of holding up in the near term. That could help to underpin some of the corporate earnings moving forward. Okay, some technical analysis. I think this will be the more interesting portion for many of you. Technical analysis for the S&P 500. Now I believe the bears are still very much in control. What I'm looking out for is for any bullish setup. I think now we are seeing that trendline break. So sellers are in control. Next level I'll be watching will be around the 4,180 level. That is where the previous resistance turn support lies. And I think for now, we are still in this sort of a retracement phase. We have the S&P 500 moderate around 9% from its recent peak. So it doesn't really it doesn't really give that conviction of that reversal just yet. Near-term downtrend for sure, but I believe that the next level that we'll be watching will be that 4,180 level. Okay, we got to see some form of a bullish setup there, and of course, that mid-October time frame could really be something that we can keep a lookout for that new added catalyst for this shift away from that from that high for longer narrative. And of course, when you look at the Treasury, recently I looked at the Treasury yields TA. I think what we are looking out for is some form of exhaustion. The last I see an hour back, things are slightly kind of exhausted on that front. So we could see that sort of a near-term rebound. But whether it can follow through, I believe that upward trend line probably have to be overcome. So I think now sellers are still in control, but yeah. My personal stand is that there are some catalysts that the bulls may tap on to really sort of fight back in the fourth quarter of this year. Okay, Dow Jones, same thing. I think very much bears are still in control. Bulls are not fighting yet. I think one that we can watch is the RSI, that daily RSI itself. So you can see that since around August, the RSI has really been trying to reclaim that key 50 level. So we tried a total of 2 times. You can see that the buyers didn't manage to push it past that 50 level, okay, from the RSI itself. So now it's still a near-term downward bias. I think greater conviction will be when the RSI has managed to reclaim. They managed to reclaim that key 50 level. Okay, Nasdaq. Likewise, I think near term still doesn't provide much signal for buyers yet. You can see that that trend line has been broken down. We have moved on to retest it yesterday. There was a bearish rejection, at least for now. So this, suggests that potentially things could moderate even further. And what I'll be looking out for next will be around that 14,000 level, where I believe that that downward channel trend line may provide some form of a support. So something to keep a lookout for around the 14,000 level. Okay, Russell hasn't been finding that conviction. Still trading within this broad ranging pattern. I think there isn't much conviction that small cap can hold up. And now we are back at its around its horizontal support. So kind of a retesting there. So likewise, I want to watch whether this holds. Otherwise, it may sort of move lower towards the next level around the 1,650 level. Okay, now moving on to the US dollar index. So I think just to sort of share, this is sort of a research done by my fellow analysts. So generally, when we talk about the US dollar, okay, it tends to find some strength when the US economy are showing a positive surprise, and on the other hand, when the US economy are showing are moderating very, very sharply, such that it's showing up recessionary fears. So I think now we are seeing that US dollar, that relentless rise in the US dollar, kind of reflecting that a much stronger than expected economy that may push the Fed to further raise borrowing costs. Okay, so that has been really driving that upward trend in the US dollar. And I think I previously shared this. What I'm looking out for is that CFTC aggregate positioning for US dollar. So generally, based on past history, when many of these large speculators sort of revert from a net short to a net long, the US dollar tends to find some upside. So we can see it based on past history. When things revert back, of course, when it stay above net long territory, the US dollar tends to sort of move higher. So now things are trying to move back up again. We are seeing that things have moved back into net long positioning, at least from many of these large speculators. So whether it marks the uptrend, it suggests that the bias for the US dollar is still to the upside, at least until things revert back into the net short. But for now, if you were to ask me, it does suggest that buyers are still sort of largely in control for the US dollar. Okay, now technical chart wise, near-term outward bias, you can see that higher highs, higher lows sort of being formed. Now we are back to test one of the key levels around the 108 level. If you were to mark a break above it, I believe it could sort of pave further upside towards the 110 level next, where the November 2022 seems to mark somewhat of a strong sell-off. Okay, but something to keep a lookout there. Now we are retesting around the 108 level. I think some resistance may sort of be expected, largely because if you look at the RSI, it suggests that there is a chance for a near-term bearish divergence. Okay, where the US dollar is forming higher highs, but the RSI is not forming higher highs. In turn, it has formed a lower high. So that near-term bearish divergence may lead to some resistance at the 108 level, at least in the near term. Whether that will provide some breathing room for equities, potentially, that will be something that we'll keep a lookout. Okay, next moving on to a gold. Gold and crude oil. I think gold has really been that when we talk about higher yields, gold hasn't been very well received, right? I mean, gold has been non-yielding, it doesn't pay much, and doesn't pay any dividend. And when we have higher yield, the opportunity cost for gold is really brought into question. Okay, so that higher yield has really been weighing down on gold. So I think with that upward trend still sort of intact for that 10-year treasury real yields, there isn't really much conviction for gold prices, at least for now. If we look at the chart, you can see that things has been forming new lows. Sellers are very much in control. And of course, the next level will be that 1,800 level that we're watching. Hopefully we can see some form of a near-term rebound, but there isn't really much conviction for a longer-term positioning. Okay, when yields were to stay high for longer, I think the opportunity cost for gold are really brought into question. So 1,800 level, I want to watch for any capturing of a short-term rebound. But overall, I believe that things are still shaky until we are able to move back above that cloud pattern. So you can see that gold prices has really been weighed by that daily Ichimoku cloud zone. So try to break it in July, August, didn't manage to do so. Recent retest in September also failed. So it has, that has really been one of the key indicators that sellers has been watching. So hopefully we are able to see a move above that daily Ichimoku cloud to sort of provide some signal, okay, that buyers are sort of taking control. Okay, silver likewise similar to gold, under pressure lately. Some deep buying yesterday. We can see that formation of a daily hammer candlestick. So one of the short-term trade, okay, of course, that you can see is any move above yesterday's high that could validate that near-term bearish pin bar, that could provide one long opportunity. But of course, when things break below yesterday's low, so it suggests that the deep buying hasn't been managed, didn't manage to gain much control. So that could actually prompt a further downside. So I think one to watch for silver, potentially some near-term, very short-term long buying opportunity if things move above yesterday's candle. Okay, Brent crude prices. I think oil prices, the bias for me, I think generally is still on the upside. One is that the tight supply conditions are still sort of very much in place. At least if you look at the US crude oil inventories, there has been sort of a significant drawdowns since August itself. Okay, the broader trend is on that significant drawdowns. If we look at the US strategic SPR reserve, okay, we are still at its lowest level since 1983. So previously, the US kind of released its crude oil reserve inventories. It didn't really replenish back. Okay, now it is still at its lowest level since 1983. So whether they will sort of have to, sort of reload moving forward, that just points towards a further tight supplies situation. Okay, for me, the chart-wise, I think I will believe, okay, that the Brent crude is on this, it is still very much on this our bias, unless the cloud support has been overcome. But now it is still on that, it suggests that buyers could still be in broad control. And prices are hanging above its 200-day moving average for the first time since September 2022. So that, could keep that ongoing upward trend intact. And if we move towards the weekly chart, okay, weekly chart, what I'm looking out for is that weekly RSI. So before that, things are on that downward bias trend where the RSI hits below zero back in July 2022. And multiple retests of that 50 level hasn't been able to find a successful break. Okay, but now, back in July, August this year, okay, the RSI actually reclaimed that 50 level for the first time, okay, since July 2022. So it does suggest that buyers are taking a greater control, break above that consolidation zone. And now the RSI is still hanging above that 50 level. So that will be something I'll be watching. I believe that still suggests a broader upward trend. And one I'll be watching out for will be around the $88 level. That was the previous resistance turn support now. So I want to see that sort of hold up to continue that upward bias. Okay, last two portion. I think one that I've received many queries about is, of course, the Chinese equities, namely the China and Hong Kong indices. Generally, the story here, I think, I think you have been hearing a lot of narrative that it is a waiting game. I think on the valuation side, of course, conditions are undervalued, but how long it will actually take for markets to find a conviction to realize its undervalued state, that is really a question. So I still believe that it is sort of one for the longer term. Largely because I think we are seeing some sort of early signs. Of course, it's too early to make a conclusion yet, but at least we are seeing some stabilizing in terms of some economic data such as retail sales, industrial production, at least last month. So I think markets will want to see more positive follow through in that sense. But of course, one of the weighing factor is that real estate, that property risk, right? So I think China is really very much about that confidence, okay, and markets are really shunning it until they are convinced that economic conditions have bottomed out. Okay, but now there is still some doubts on whether we have seen that worst is over kind of a narrative. So I believe that things could potentially drag for longer, but it doesn't mean that you have to shun it totally. It's just more of really a waiting game playing out. And recently, the CPI has also reverted back into positive territory. Of course, one data point doesn't make much of a trend. So I think we have to continue observing. Hopefully, we are able to see a more sustained economic recovery being played out, okay, to show that recent commodity policies are having some form of a success to really convince that buyers, okay, that the worst is over, has arrived. Okay, but for now, I think much still awaits a very muted front on the growth data. So I think probably really a more data dependent kind of a stance may be warranted. More of a patience, more of a waiting game, at least for now. Okay, and the economic surprise index likewise still below zero. It means that still underperforming market expectations, but at least it is underperforming to a lesser extent. Okay, so whether we can move back above positive territory, which means that surprising on the upside, that will be something that we will watch in the fourth quarter. And if we are able to see more economic data surprising to the upside, that could really prompt some traction flowing back into Chinese equities. And recently, there has been some form of a deep buying from leverage funds, from foreign investors as well. So I think there are really many of these large institutional investors. They are still retaining their exposure, but it's really on that when it will take for a policy to for easy policy to really have a positive impact onto economic conditions itself. So very much a waiting game, not too much of a signal, at least for now. I think things are still very muted. I think the property sector risks are still one of the overhang for risk sentiments. So really more, I believe it's really much more for that longer term play. And for the Hang Seng Index, I think you can see this is the weekly chart. What I'm looking out for is that that weekly Ichimoku resistance cloud itself. So you can see that the index hasn't managed to reclaim back above it. Okay, since you can see that we have tried to break above it since start of this year, in early 2023 on the reopening play. Intermittent bounce to sort of test the upper edge of that resistance cloud. So far didn't manage to find that decisive break yet, and now things are trending lower. So of course with that, what I am seeing is that it could potentially mark that very key indicator that sellers are watching, and until we are able to move above around that 20,000 level, they move above that cloud resistance to signal some form of a upward trend in place. I believe that things could sort of be flat to slightly lower for a Hang Seng Index. Okay, last but not least, for those trading or investing in the Singapore market, you'll know that I like to look at where the institutional investors are positioned. So you can actually find this from the SGX data every Monday. So they'll sort of review how the institutional investors are positioned, okay, every week. For now, I believe at least on the economic front, things are still very, very subdued, largely because we are a very export-driven economy. China is not picking up as strongly yet. So you can see that our exports have been on this year-on-year contraction over the past few months. Okay, and this is in line with the regional performance. I think if you look at some of the exports from South Korea, it has also been on this contractionary zone. So growth hasn't been that strong, hasn't provided that conviction yet that we can sort of avoid a recession. I think the growth risk is still very much that key overhang for a risk sentiment itself. If you look at it, Singapore's PMI hovering around 50, kind of a flat to subdued growth outlook that we are looking at. And this is the institutional fund flow data. We are seeing some pockets of net inflows from institutional investors. but I would say it doesn't really provide much of a clue. I mean, the Straits Times Index has been on this broad form of a ranging pattern over the past few months. And I believe that ranging pattern could follow moving forward. And we haven't really seen that strong inflows from institutions yet. I mean, there are some weeks of a net inflows, but on the broader scale, since the start of this year, you can see that it's still kind of on this cautious mode. I think the outflows are still far outweighing the inflows for now. So we got to keep a lookout for further inflows. Of course, that is just a confirmation kind of an indicator. But at least for now, it suggests that there isn't much traction from institutional players, at least for the STI itself. And the price action has also stayed that it's just on this, on this broad ranging pattern. In terms of a sector breakdown, I think the financials are starting to gain some traction a little bit. You can see that uptick in the yellow line, a little bit of traction on that hawkish Fed. So some expectations that their upcoming earnings may continue to hold up strong. Fair enough. On the downside, we have REITs. The REITs has really just been losing traction, ever since the COVID-19 period. When rates go higher, it really challenged that dividend-paying traction for REITs itself. And when we talk about REITs, generally there's this higher debt cost that comes into play, and doesn't bode well when interest rates are staying high for longer. It does really challenge their earnings that they can deliver. So I think REITs are still not gaining much of a traction. If you look at the S-REITs ETF, it has actually dipped past its COVID-19 low. So not too much traction on that front. Yes, so when things are really hawkish, the property sector, the REITs are seeing that outflows, whereas some form of attraction are in financial stocks itself. Okay, so this is what I'm saying. STI on this broad ranging pattern doesn't really provide much of a cue. Of course, for a range trading, I think the key support to watch is around the 3,150, where it has really supported prices on previous occasions. But of course, doesn't provide much of a clue for a longer term upside. So I think the normal range trading kind of strategy will work here in terms of that bottom line at 3,150 and that upper resistance around that 3,330 level itself. Okay, and this is what I'm saying. As REITs, definitely not a lot of traction in the near term. More of a longer play, as you can say. But generally, I will still, I wouldn't overly expose myself to S REITs. One thing that you can look out for is that yield spread. I think when you have that government risk-free bond rates going higher, I think the premium that you spread with the REITs dividend yield is really brought into question. So now it's still below that 10-year average. You can see from that green line on the chart on the left. So until we are able to see that potentially bond yields have peaked, I believe that the narrative for S-REIT could continue to be a low for longer kind of a narrative. Okay, and that rounds up my webinar today. As I mentioned, I think a lot of these pointers, I have actually brought it up. I have shared previously in my weekly market scoop, which takes place every Tuesday around 5 p.m. So I think it's totally free. It's just a half an hour session, 5 to 5:30 p.m. So when you are free, just feel free to hop on. And what I'll go through is weekly updates on what's happening in the markets, some trading ideas that you can watch. And of course, I think for now, we will be taking a break, but we will be back on 24th of October 2023. So how you can keep a lookout for this, it will be broadcast onto the Telegram group. So if you are part of the Telegram group, we will send some form of a link and a reminder every week for you to sign up and just tune in. You just tune in to sort of know what's ahead and be more updated on some of the market moves. Okay, so with that, I've come to the end of my presentation, and I will just look at some of the questions, okay, that you all have. So let me just take a look. Okay, I think one question is, shouldn't rate cuts be priced in already? Okay, so yes, I think if you look at the rate expectations that I shared based on the Fed Funds futures pricing, okay, what markets are expecting is that the Fed may not follow through with a large rate hike, but rates will continue to stay high for longer. So previously, they were pricing in more rate cuts and also earlier in the year. But after that hawkish guidance from the Fed, I think we are at this recalibration stage whereby we are seeing a rate cuts being priced towards the later half of the of next year itself, and that is what has been driving that whole that hawkish recalibration phase that we are seeing now, which comes with the trade-off for equity performance. So I think we are still in this recalibration stage, and like I mentioned, I believe that moving forward, I think markets may potentially start to shift focus more onto the upcoming earnings season, and that is where the bulls will really have to sort of tap on some economic resilience to sort of fight back against the recent downside performance. Okay, next is that is it true that recession indicators are also highlight when there are job losses in the building and construction industry, when there are no new building projects? This will also have a knock-on effect on other sectors to cause a recession. Okay, fair enough. Yes, I think some other indicators, of course, that can be one indicator that you can keep a lookout for. But generally, from my point of view, I think coming out from COVID, there has really been that wide divergence between that manufacturing and services kind of a sector. So previously, that consumer sentiments has been moderating sharply. The manufacturing sectors have been very weak, but the services side of things are very strong. So that kind of even up some of the growth that we are seeing. So I think overall, I will still sort of stick to some of the recession indicators that I shared previously. I think that uninversion of the yield curve, okay, that continuing jobless claims that I'm watching, along that downturn in consumer, any downturn in the consumer sentiments ahead, I think those could also add on, okay, to that recession indicators that you also have. Okay, next, let me see. Any other? Why is the US consumer so strong? I think that has really been that question that many people are asking. Even at the start of this year, there has still been that ongoing recession talk, but now that recession risk has really been, we are seeing less of that now. It's more of a soft landing hope that people are having. I think that, in a way, they are still borrowing. Okay, the consumer debt is increasing, they are borrowing, they have some reserve from that COVID-19 pandemic. Those are still helping to support some form of spending. And that has really been keeping things sort of more resilient. And of course, when we look at the US jobs market, I think there is still a very strong demand for jobs itself. So that has really been keeping that economic resilience that we are still seeing at current point in time. So of course, recently with that, we got to look towards Friday's non-farm payroll. Recent indicators suggest that things may potentially hold up. Expectations are also for unemployment rate to hold up. So that could sort of in a way that could challenge the Fed, whether they may have to maintain hawkish, but if you are able to see further softening in terms of the jobs numbers, then they may have some room to sort of a push rate in November, and that could also be something that the bulls may tap on for some form of a year-end rally, in my opinion. Okay, next, On the indicators that you use for recession early warning, shouldn't we look at some financing mortgage? Yes, you're right. I think the mortgage default rate hasn't been very promising. I think even if you previously I was looking at the credit card form of default rates among many of the smaller banks, I think it has also reached its multi-year high. So it hasn't really been, economic conditions has really been on that, weaker side of things, but it's really just kind of being balancing out in terms of, economic resilience, at least on the services side, at least on the US employment side of things. So I think there are some risks. There are surely some risks that we are seeing in the markets. It's just, what will be that breaking point? What will be that trigger for it to really prompt that cracks in the economy? That will be something that, that definitely will be watching out for. Okay, so when is the current market pessimism likely to reverse? Like I shared, what I'm looking out for is that upcoming earnings season. I think now, without much of a catalyst in the markets, right? So ultimately, things are still revolving around that recent takeaway, that hawkish takeaway. But moving forward, I think the market attention may shift towards the upcoming earnings season. And, that could provide some form of a diversion into a year end for markets to really, for the bulls to really tap on. Okay, let's see. Oil inventories. Okay, I got a question that says, are oil inventories falling since 1983 from my slide as the global market moves to EV? Okay, I think the slides that you're talking about is that that reserve that US actually hold. So many countries actually hold oil reserve. Okay, their own stash of oil reserve. So that chart actually shows that if you were to recall previously, the US actually released some oil supplies from their reserve, okay, in order to keep prices down. Okay, when you have more supplies in the market, prices tends to moderate. So they have released these. They have released a huge chunk of inventories from their own reserve. Okay, so that slide largely show that after they are released, they hasn't really replenished yet. So when they start to replenish, it means that they got to buy back from the market itself. So I think the broader theme that I'm trying to highlight here is really that tight supply conditions that is still in a way very much in play for oil prices. Yeah, so that is what I'm trying to highlight. Okay, I think, will there be possible Blacktober? Okay, I think, yeah, I think at least from that seasonality side of things, I believe that mid-October will really be that sort of that turning point that bulls could tap on. Of course, we got to reconfirm that with some of the bullish setup on the technical side of things. But that will be something that can help to fuel some form of a upside for the equity markets into the rest of this year. So definitely something that we will keep a lookout. Of course, in the near term, I think sellers, we are not seeing much of a signal yet. Sellers are still in control. We are seeing trend line being broken down into. So definitely want to watch will be that mid-October period onwards, whether we are able to see the buyers stepping back in from that a potential rate pause from the Fed, and of course our economic resilience still keeping corporate earnings up. So that is what I'm looking at. We'll do a webinar on AI and its next phase. Webinar on AI, yes, I think previously we have some form of webinar on AI, but I think the AI hype, yes, I think it's still very much in place, but we don't see it as much on the headlines. So we are also seeing semiconductors, really a lot of profit taking coming from there. I think previously we have done, I think good feedback. I think we will definitely explore on whether we will hold another AI webinar. Okay, so I think with that, I've come to the end of this presentation, and of course, thank you very much for tuning in on this Wednesday night. Hopefully, you are able to have some form of a takeaway on some of the things that I'm looking at, and of course, if you are interested in being sort of more updated on the markets, we have that weekly market scoop that feel free to jump in and join us every Tuesday at 5 p.m.